And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the start of another week here on the Real Investment Show. Glad you're joining us this morning. Lots of stuff happening this week. We have the CPI report out this week, PPI as well. So we're going to have inflation data to deal with this week. And again, the big question is inflation continuing to fall? What does that mean for the Fed? Rate cuts, of course, that is all coming right around the corner as well. The next Fed meeting coming up, but at the end of the month, we have the Jackson Hole Economic Summit. This is, of course, the annual confab of economists from around the world that come in and all sit around and discuss how they're going to rule the world through monetary policy. So we'll get a lot of feedback from that, but that will kind of lay the groundwork for rate cuts going forward. Because again, during this presentation, over the last couple of years in particular, as an example, last year, Fed Chairman Jerome Powell rewrote his entire speech like 15 minutes before going in because of changes to the market environment. So again, we're going to see some of this coming out, some of this kind of data between now and then. That's going to help shape that meeting as well and shape policy. The question, or the belief right now anyway, if you take a look at Fed funds futures, is that the Fed will cut rates in September. This is going to be the big question. Will they, won't they? It's just prior to an election. We'll see what happens. But right now, markets are expecting as much as a 50 basis point rate cut in September because of what happened last week. And we're going to discuss a little bit of that here in a second. But the reality is more likely it'll be a 25 basis point cut. That's at least what's getting kind of baked in right now to the market, so to speak. But we'll see how this plays out. But again, lots of important data this week. We are about 80%, we're over 80% done with earnings. We've got this week, the last of the laggards come in. NVIDIA reports at the end of the month. I think that's the 27th. Don't quote me on the date, but I think it's right around there. But that's going to be the last big major kind of tech company will be NVIDIA. And then right around the corner, we'll start this all over again come October. But, that's, the buyback window is now opened back up. So again, we're going to start getting stock buybacks in. That actually kind of started last week as well as companies finished reporting earnings. Those buyback windows open back up. Corporations can step back in now, start buying securities. But so again, we've got a lot of that stuff kind of behind us now. We know what earnings season was. It wasn't great, it wasn't terrible, but it was okay. And markets kind of worked their way through that process. Guidance was okay, wasn't great, wasn't terrible. Forward outlooks were okay, they weren't great, they weren't terrible. Did notice though, through a lot of the reports, there were a lot of companies beginning to talk about consumer strain. So we're now starting to see kind of the companies coming out saying, yeah, consumers not as strong as they were. We're starting to see a slowdown in spending. Those are kind of our concerns going forward. So there's kind of a couple of reflections coming out of this from, of course, is that first of all, companies will start doing inventory management. If demand is slowing down, they're going to stop stocking as much inventory. They'll start to roll off their inventories, et cetera. That could put a little bit of economic drag on the economy because, again, we don't produce as much to stock in inventory, right? We don't order as much stuff. So that potentially slows economic growth some. If the consumer is also slowing down, that will impact earnings. So we're going to probably see earnings estimates start to come down here over the next month or so if that kind of data holds true. Now we're about to go back to school. My daughter informed me yesterday that school starts on Wednesday for her. So she's not at all excited about this. But she's going back to school. But again, we're going back to school shopping now, right? So that's going to get reflected. Oh, also this week we have retail sales data for July. So we'll get kind of what the month of July was. But, we'll, as we get in through August, should see an uptick in retail sales, typically back to school shopping, those type of things. Typically tends to be a little bit stronger month. But that'll give us a really good read when we get into September to look back at August retail sales. If August retail sales are weak, that's going to tell us a lot about whether or not these kind of outlooks by these companies about weaker consumer spending are indeed factual. So again, and again, they are. I mean, the companies are just telling you what's going on. But again, we'll see if this is going to be kind of a bigger theme that could weigh on earnings as we go into the rest of the year. Okay, here's what you need to know before the bell this morning. Last week, obviously a very volatile week. Monday, markets were down 3% on Monday. And of course, that was the big yen carry trade blow up, volatility shock. Everybody was just kind of really taken off guard. As we talked about last week, though we're still really just in this correction, this 5 to 10% correction that we talked about in June, July, just still in that process. Nothing really overly dramatic about it other than that sell-off on Monday. That really kind of just got people by surprise. It was just a big sell-off and a big jump in volatility and really, kind of just woke up slumbering giants, so to speak. But we did see a lot of sell-off. By the end of the week, though, we completely reversed that sell-off. So that whole sell-off on Monday was recovered by Friday. Again, still oversold here a bit and still on a sell signal. So again, that's going to suppress kind of upside movement in the markets, at least near term. And as we kind of talked about, last week several times, is that, be sure and use this rally. Again, markets are looking to be up a little bit more this morning, kind of a muted open, to say the least. Dow's up about 40 points right now in futures. But use this rally to potentially reduce some risk, rebalance your portfolio. If you didn't like that sell-off on Monday, if that really kind of woke you up and you didn't kind of like that action, so to speak, use this as an opportunity to take a little bit of money off the table. Again, just if you raise some cash here, that doesn't mean sell everything, but if you just raise a little bit of cash, add to your fixed income, whatever, that's going to give you a little bit better opportunity to just kind of weather whatever happens next. Again, there's some pathways here that we can kind of see this market take. First of all, we've got a lot of resistance now coming up right here at the 50 and the 20-day moving average where that's starting to cross. So that's going to provide a pretty strong resistance level for the market. So if the market can rally to that, I would expect a bit of a retracement following that. Just, again, we have a lot of these trap longs. They're in the markets. They're looking for an exit. And so if we get to a key resistance level, that's going to certainly provide, kind of that potential area to start selling into a bit for the markets, particularly with the 20-day moving average now moving down. Right now, we did break above the 100-day moving average on Friday. So again, that took out one level of resistance, but that was just the initial test. So we've got to stay above that for a couple of days. So I think right now, the most important resistance level, just kind of keep a watch on it, is that crossover between the 50 and 200. That's going to put some downward pressure on the markets. But again, kind of watch this buy signal. If we can get that sell signal to revert back to a buy here in the next few days, that'll start providing a little bit of support for the market, start to bring investors back in. But again, I think the most likely, kind of opportunity here is that we get a bit of a rally. The market retest kind of maybe a rising bottom here, somewhere here, set a higher low, and then potentially rally from there. The bigger risk, of course, is a pullback to the 200-day moving average. That is rising. So again, we see a bit of a pullback to that support level, certainly not outside the realm of possibility either. And again, that could kind of take us into, mid-September-ish, maybe even early October. We could just kind of chop around here for a bit, with the markets, here for the next month or so. Again, these correctional processes can take a little bit of time. And we can kind of work through that process again. But what we're looking for here is ultimately for this market to kind of stabilize after that big sell-off that we saw last week. I wouldn't be surprised to see that. We got people fairly negative across the board. Lots of articles out right now talking about the death of AI and the mega cap stocks. Don't buy into a lot of that right now because again, those stocks are driven by the passive indexing effect. So if we get people invested back into the markets, that's going to drive those stocks. And particularly we're seeing hedge funds now that had degrossed a lot in those stocks early on in the last couple of weeks, now buying back into those fairly heavily. The bullish side of this is we crack above this resistance level and we can go back to all-time highs. So again, there's kind of two pathways here to watch, but I think the most likely here, we get a rally to resistance, a failure there, retest of lows, and then that's going to be your better buying opportunity. And that's just going to take some time to get there. That's what you need to know before the bell this morning. We come back, we'll talk a little bit more about what happened, where we're going to go to next. Got some other stuff to get into this morning as well. Stick around for more of The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I'm starting to like you guys in chat a little bit. Question is, Lance likes saying confab, whatever that means. Confab is a private conversation or informal conversation. So basically, when you get a bunch of people together and they're just kind of talking informally, then that's a confab. So it's just a group of people talking. Could be two people, could be more than two people, but just it's a conversation. That's all it is. Of course, the big chat right now in the chat, everybody's talking about education. Back to school. Didn't learn anything after the third grade. Larry, you learned how to read and write. That was why you went to school. Basically, you go to school for reading, writing, arithmetic. That's the 3 R's. Hopefully the 3 R's, right? Anyway, so a few things. So kind of going back to what we were just talking about a second ago, the big question is, is the crash over? That's the big concern, right? For a lot of investors, the shock of last Monday took a lot of people by surprise. Like, oh my gosh, here's that crash. We've all been expecting, and I've gotten lots of emails over the weekend as well. Just, is the crash over? What's going to happen next? Where do we go from here? That was kind of the subject of this weekend's newsletter as well. But looking through the data, again, we have to separate out volatility spikes versus market corrections, right? And what was driving the spike in volatility versus what drives a bigger crash in markets. And we never know that for sure. We never know. But this is where we have to kind of be a little bit cautious on making drastic moves in portfolios when something unexpected happens. What happened on Monday was a volatility event. And those type of events tend to be very sharp, very quick, and then they're over for whatever reason. And that's a lot of what we saw. And again, this is kind of what we went through in the newsletter this past weekend, is looking at previous periods in the markets where we had these type of events that occurred. And Brent, you can bring up both squares on this page. But if we look back in history and we look at previous periods, so this is 1987, 2011, 2015, and 2018. So each one of these periods, leave these up for a minute, Brent, for me, don't take them down. So each one of these periods had something specific going on with them. So of course, crash of 87, that was portfolio insurance that went wrong very quickly. In 2011, this was when we had the meltdown of Japan. Basically, you had an earthquake that caused an undersea earthquake that caused a tsunami that flooded Japan, that caused a nuclear meltdown. Godzilla comes back. It's all great. But they had to shut down everything, right? So we were getting no exports from Japan at all. 2018, you had the same type of event kind of occur. This was when the Federal Reserve said, basically, we're nowhere near neutral rate. And the market had to adjust very quickly to what they thought at that time was going to be much higher interest rates. Of course, that didn't turn out to be the case. And in 2015, that lower right-hand corner, you had that very sharp downdraft. This was the taper tantrum the market threw as Janet Yellen announced they were going to start hiking rates and cut QE. So all of these events are very short-term events caused by a volatility event. In other words, a very unexpected exogenous event that the market had to reprice for. And those type of events like this are repriced very quickly. The market factors these in. We've talked about this before. When you're thinking about some event in the world, right? You wake up in the morning and there's news on the head. There's market news about Iran bombs Israel or whatever. And you're like, oh my gosh, this is the thing that's going to cause the market crash. Again, the markets price those in very quickly. They very quickly adopt for higher oil prices or lower oil prices, whatever you're looking at in the mainstream media, whatever somebody's talking about in the mainstream media, is unlikely to be the case. I saw an interesting article this morning, just as a point, and there was a portfolio manager, and he's talking about next year, and in 2025, we're going to have a 20% crash because the Fed won't cut rates fast enough. If the Fed's cutting rates, the market's going to price in whether or not they're cutting rates fast enough, right? Now, that doesn't mean the markets won't go down, right? But to have a very sharp 20% correction next year, the markets will price that in way before we get there. So again, you can discount that immediately. And that's the issue with those things that we know. We've talked about this numerous times here on the show. Is like, be careful of those thematic events. People that talk about these themes, whatever they are. The markets are pricing those in very quickly. When it's unexpected and it catches the markets by surprise, that's what causes these very sharp downtrends, like we saw on Monday. Right. And so these volatility driven events, they're very quick, right? They happen quick. The market prices them in. It's over for the most part. The thing that causes a much bigger downturn in the markets are things that are credit related, generally, or things that have a more significant economic impact. Again, things that nobody was expecting, of course. And we can talk about some of those in history, right? So in 2008, normal bear market starting, and then we forced Lehman into bankruptcy. Nobody saw that coming. And the Lehman bankruptcy, as we've talked about before, just froze the credit markets. Nobody would trade with anybody. And that's why you had such a dramatic drop in the market, because the market couldn't price for that, because nobody was willing to trade. So nobody knew what the price was. Brent, I'm sitting there going, hey, would you please take stuff off my books? And Brent's like, no. Just name a price, any price. No, I won't take it at all, right? And so there was no price for the market to work off of. And that's why the market declined so rapidly after the Lehman event. Go back to 2000, dot-com crash, right? That wasn't a credit event. There wasn't a credit event. That was a financial event. And that was when all of a sudden Enron blows up. Everybody discovers that Enron is a complete fraud. Now, if that was the only company, right, that would have been a very short-lived event. The problem is that when Enron blew up, everybody started looking at everybody else going, well, if Enron's books are phony, what about yours? And that was where we started to question all these fundamental assumptions that were made about these .com companies, and it just unraveled the whole thing, right? Enron, WorldCom, Lucent, Global Crossing, just right on down the list, these companies just all fell apart because it's not that they were all Ponzi schemes or frauds, but the fundamental model just didn't work. Everything that people were pricing on just wasn't real. And so you had to reprice all that. And that's why if you go back and look at the .com crash, it really was focused primarily on .com stocks. Small caps, mid caps, they hung in there. They went down, right? But they didn't, blow up. But, other companies, ExxonMobil, whatever, they did okay. They were down in price, but, they did okay because they were fundamentally good companies. But you go back and look at every period in history where you've had these much bigger drawdowns. 1974, the Nifty 50. Right? There was just assumptions being made that when the assumptions were invalidated, the market had to reprice for all this stuff. And it was unexpected. There was a trigger event that caused every one of these bigger drawdowns to be questioned. And once the question started, then the bottom fell out of the rest of the market. And so the market couldn't see those things coming until that occurred. So Monday was not that event, right? Monday was just a volatility shock. And again, that's just a function that when the yen went up, as we talked about last week, the yen spikes, I have to cover those margins. Right, because I was shorting Japanese bonds, basically shorting the currency and going long U.S. stocks. So I've got to cover that. Well, that's a very quick process. So as soon as that's done, as soon as I'm covered, it's over. And that's what we kind of saw by Tuesday morning. A lot of that coverage had been done, and that's why the market started to try to rally, and we kind of wound up rallying through the end of the week. So again, as we talk about these periods, it's important to segregate out the difference between a volatility spike and a credit or financially related event that is also exogenous and unexpected. But again, that's the key term to all this that we've talked about so many times here is be careful. The things that you think you know, and I could sit here and go, okay, chat, this morning, give me all the reasons why the markets are going to crash next year. And again, the market, you can't come up with one the market hasn't already priced in. Because that's just the way markets work. Markets are real time. So you have to remember, markets are not this ethereal thing that's sitting out there. This is the minds of millions of people buying and selling stuff all day long. And there's a whole group of people just like you that are sitting out there with whatever concerns they have, and they're making buy-sell decisions based on that. So when they're making buy and sell decisions on all these events, all these ideas, everything that you can possibly think of in the world, there's somebody else that already has that thought, and they're already trading off of it. So again, that's why these events that shock the world, so to speak, have to be something that totally blindsides the market. Because then because all that means is that the market, all of a sudden, something happens that the market wasn't aware of, and now I have to reprice for that potential impact. All right, quick break. We'll come back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult.
There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yep.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So the Olympics are now over, and here's the thing, Brent. I have mixed feelings about professional athletes playing in the Olympics.
Yeah.
Right.
Yeah.
I mean, and we started this back. I can't remember when we first introduced professional basketball players into that. Was maybe early 2000. I have to go back and look. Maybe late 90s.
Is it for bragging rights or what?
Well, no. It's just hey, it's the Olympics. We want the best players. But yeah, I used to compete in martial arts, right? And I did UFC before UFC was a thing, and we traveled all over the world, competed, and I represented the U.S. martial arts team and whole 9 yards, and it was a lot of fun. But I traveled all over the world, but it was all amateurs, and it wasn't people that were professionally paid. This like their whole life, they just their whole life is being paid to train and work for this one event. And that's kind of the way I feel about the Olympics is that that should be there's a lot of athletes that aspire through high school and college, whatever it is, they train, they compete, and all that. Kind of the Olympics is the highlight of amateur sports, and I just always felt like when you introduce professionals into that, it kind of takes away from the meaning of the Olympics of what it should be, which should be for amateur athletes that have trained all their life to achieve some level. But that's just my opinion, anyway. But I'm glad it's over. Had enough of it this year.
Now what are we going to watch?
I am personally a winter sports fan. I like the Winter Olympics better than the Summer Olympics. Although we had some pretty impressive performances out of our track and field athletes, and some pretty nail-biting finishes. But I personally, I like winter sports. Yeah. And I don't know why. Did they introduce breakdancing this year to the Olympics, which I didn't understand. So I don't understand why we don't have UFC as part of the Olympics yet.
What is that all about?
Yeah. My favorite one is the whole story about the Turkish shooter. You know that story?
I do not.
Oh. So apparently Turkey, the guy that was going to compete in shooting for Turkey, had to bail out at the last minute. So they went and called this one guy, and they're like, "Hey, we need you to come compete." And he was like on his way to lunch apparently or something. He's like, "Okay, I'll be there." So he shows up, and literally, like all the other kids, these young kind of millennial Gen Zers, right? You know, they're up there. They've got these special glasses on. They're wearing these special outfits to shoot. And he literally walks in with a T-shirt and a pair of pants, puts his hand in his pocket. He's wearing regular glasses, takes the pistol, shoots, and wins the silver medal. I mean, and apparently this guy, they say, right, he's part of the military in Turkey, and that he would have done better, but he's used to shooting moving targets. So, so I don't know what this guy actually does, but...
He's used to shooting live targets.
But he was so casual. I mean, everybody else is dressed in uniforms.
Yeah,
all this. He's wearing a T-shirt that says Turkey on it. Has one hand in one pocket and shoots. Right. I'm like, okay, I'm impressed. Anyway, so a couple of things. Let's talk a little bit about the AI trade, because this has been one of the big narratives of the sell-off this past week. Is that, oh my, it's the death of AI. Be a little careful. I've got an article coming out tomorrow about mega cap stocks. But what's important is again, narratives. And if you take a look at how hedge funds were positioning ahead of this correction. So this is prime book equities. This is hedge funds basically. And in July, there was a very sharp drawdown in the big mega cap stocks. In other words, they were selling big mega cap stocks well before this volatility event on Monday. So they were already degrossing their book in these stocks. What did they know? Who knows? But while everybody else was buying these mega cap stocks, they were selling. And as they were selling, this is why back on July 13th, we sold down our mega cap stocks as well, because we were watching this kind of selling going on in the background. Like, hey, what does somebody know that we don't know? And so they were already reducing that. Of course, we had this big blow up on last Monday. Volatility spikes. I don't need that chart, Brent. This is the one I need. So volatility spikes, and all of a sudden, we see a reversal. So while everybody's panic selling, and we go back now and look at that, this is that same chart that I just showed you. And you see that there was this kind of consistent selling by these hedge funds going into that correction. Then when we had that sell-off on Monday, they're buying. So again, there's a lot of conversation around. I'm seeing a lot of articles like, oh, it's the death of AI. Be careful of that. And we're gonna talk some more about this tomorrow, and I'm gonna go through all the reasons why this mega cap trade is probably not over yet. But again, these are more narratives. Are these big mega cap companies overvalued? Absolutely, right? Do they need to have a reversion of valuations at some point? Absolutely. But the triggering event for that is not yet available. And as we will discuss more tomorrow in more detail, is that these companies in particular are a function of several ingredients. And the reason that hedge funds are now regrossing, so they degrossed going into that volatility spike on Monday. Now they're regrossing those positions. Well, the reason that they're regrossing those positions has a lot to do with the fact that if I've got billions of dollars worth of capital that I have to invest, right? So remember, if I'm a hedge fund, or if I'm a mutual fund, or if I'm a pension, or if I'm a insurance company, I have to keep my money invested. I can't be sitting in cash. I have to invest. Me, I can hold cash. If there's something going on in the markets, I can have 100% cash in my portfolio if I want it, right? I have that flexibility with our clients. I better be damn sure I'm right if I'm going to do that. But I have that flexibility. Hedge funds don't. If they're not invested in whatever it is, they have to basically not charge on the book. And if they're a hedge fund or if they're a private equity firm, whatever it is, if I'm not using that capital, I got to return it. So they have to be invested. So so if I've got billions of dollars, so if I'm degrossing my book and I'm holding a bunch of cash for an event, and look, these guys that are long this carry trade that we talked about last week, right, where they're short the yen, long U.S. bonds and stocks. The spike in the yen didn't occur just overnight, right? It was building for a couple of weeks and then it spiked, right? There's always a precursor to an event, right? There's symptoms before the event, right? You don't wake up one morning and you're just sick, whatever it is, right? You just don't wake up one morning, all of a sudden you've got some disease or whatever it is. You were getting it for a long time. You just ignored the symptoms. Well, these hedge funds saw the yen rising, and then when it hit a critical juncture and the margin calls came, then all of a sudden that was when it spiked, right? That was that whole shift on Monday. But it was the precursors were there, and that's why they were reducing that mega cap exposure over the couple of weeks prior to that spike, right? The market was already correcting. We started correcting 3 weeks ago, and then before we actually got into this whole volatility spike on Monday. So they saw this coming. So while now everybody else is panicking on Monday and selling everything they own because of this volatility spike, they're in buying the market, right? Because I have to allocate this capital, so I've got to move it. So where do I move it? I can't go buy a lot of small cap companies. Again, if I'm a major hedge fund, if I'm like a Ray Dalio or a Sequoia or whoever that has billions of dollars to invest, I can't go buy a small cap company because I'll own the whole company, right? I have to move millions of dollars at a time. So I have to use highly liquid, stable companies that I can move money into and out of without affecting the price a whole lot. And that's mega cap stocks, right? That's Apple, it's Eli Lilly, it's those companies. So these big companies, they're a safety trade. They generate earnings, right? They have earnings growth, but they're highly liquid. I can move money into them and out of them very quickly without moving the price dramatically. And so that's what you saw on Monday, is you saw while everybody else is selling, they're in there buying. And that's why over the next couple of days, the market kept rallying every day through the end of the week because they were in there buying those stocks. And again, we saw those stocks, kind of performing through the end of the week. So again, be careful with the narrative that AI is dead. For one reason and one reason alone, and again, I've got 4 that we'll go through tomorrow, importantly. But for one reason and one reason alone, more than anything else, it's about liquidity. I've got to be able to move money. And there's not a whole lot of places in the markets right now that I can move money like that. Costco, Home Depot, Lowe's, Comcast Communications, Verizon, those can accept money flows, right? They're big enough. But small mid-cap companies are much more problematic because of that reason. All right. Quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These
men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. All right, getting ready to kind of wrap things up a bit. Yes, in the chat this morning, somebody said, name a topic. Lance probably wrote an article on it. Yes, since 2001, when I started working with Brent, I've written 5,682 articles. So yes, you name a topic, I've probably written an article on it at some point, or maybe 2 or 3. There's probably nothing you can pick that I haven't written an article on at some point. In the finance world, right? Or economics, right? Yeah. So, yeah, I haven't written automotive repair articles yet. Maybe that's my next career. I don't know.
Do yourself dentistry?
do it yourself dentistry. No. Well, I've done that, but
I know.
No, I haven't written an article on it. Okay. Today, economically, not a lot. We have Fed 1-year inflation expectations are out today. That is worth paying attention to this morning because inflation expectations have a very high correlation to the direction of inflation itself. Again, this week we have CPI, which is expected to come in around 0.2. As usually, that's kind of the base estimate. That's always going to be 0.2. It could be a little bit higher. We could see a little bit higher read, maybe a 0.3. This month, we'll see. There's some things that were going on in July that could, and again, remember, when we take a look at CPI, we're talking about year-over-year rates of changes. So we're looking at this period last year comparing the rate of inflation. So there's some things that were going on in the month of July that could give us a little bit higher print. It won't change the Fed's trajectory much, but it could weigh on bond yields short term, which are still overbought. We're still going through a correctional process in bond yields. We had that very, very sharp spike in bonds on Monday. Bond yields got extremely overbought at that point, or I should say bond prices got extremely overbought, bond yields very oversold. So then on Tuesday, Wednesday, Thursday, we started to reverse that very big spike. Again, that was not unexpected. I had talked about with Adam on Tuesday that I kind of expected a reversal in yields back up to around 4.1%. I think we got to like 3.99 on that reversal. So got right kind of into that target technically. Bonds rallied a little bit on Friday. But again, I don't think we're through that reversal correction process just yet. So again, if we get a little bit hotter than expected inflation number, yields will probably rise a little bit more. Bond prices come down a little bit more. And again, we're trying to look for that. We're trying to get bond prices. They were extremely overbought I'd love for them to come back, get a little bit oversold here, hold support at this cluster of moving averages right where bond prices are sitting, and then have a better opportunity to add some bonds to portfolios. But just be, as I said on Monday, it was too late to buy bonds at that point. They'd already moved too much. So we'll get there. But again, I just, we could see that just a little, see that a little bit hotter than expected inflation that could potentially drag on stocks a bit as, concerns about maybe the Fed won't hike rates. Maybe they'll wait. Maybe they won't cut rates I said hike rates, sorry. Maybe they won't cut rates in September as expected. Maybe they'll wait because of this inflation. So there'll be all this narrative, right? But it won't really affect the Fed very much if it's 0.3 versus 0.2. They're looking at the longer term trend of inflation, where things are going. But again, the inflation expectations today will give us a little bit of a hint about what CPI may or may not be. If that comes in weaker than expected, then that's going to be potentially good for stocks today. We'll see. There's not a lot, again, economically speaking, until Wednesday. And Wednesday CPI. Thursday is retail sales and housing numbers, et cetera. And then Friday is consumer sentiment. So we've got a good bit of economic data between Wednesday and Friday of this week. Now, the NFIB report comes out on Tuesday, which is the National Federation of Independent Business. It doesn't get a lot of press. It should. It doesn't, because the data it shows is very key to what's happening with small and mid-sized businesses. And there's a very high correlation between the NFIB index, year-over-year rate of change, and the Russell 2000 year-over-year change. And as we saw, NFIB has been declining on that year-over-year rate of return. So small and mid-cap stocks have been rallying a bit here recently. Now, I gave up a bunch of that this past week. But that gap between small and mid-cap stocks in the NFIB report is going to close. So either NFIB is going to come in a whole lot stronger to catch up with the Russell 2000, but it's kind of hard to see with what's going on economically speaking, right? Or we're going to see more of a correction in the Russell stocks as they catch back down to NFIB confidence. So again, pay attention to that. If you're kind of long small mid-cap stocks, and you're trying to build a thesis around why those stocks will keep performing relative to other stocks, pay attention to NFIB, because there's a very, very high correlation between that year-over-year rate of change in the NFIB report and small and mid-cap stocks. And there's a gap right now that shouldn't exist. And those have previously happened before, and small-cap stocks always catch down to NFIB, generally not the other way around. So just, again, kind of something to kind of pay attention to. All right. Outside of that, again, there's a few things just to kind of be paying attention to over the next, kind of month or two. But again, just nothing out there. There's no kind of big events at the moment, right? So, outside of the Fed rate cuts, right? That's the only thing kind of really driving the markets. But we're through earnings season. So markets are going to kind of really be hanging on economic data over the next couple of months, and we'll kind of go from there. Okay, so outside of that, don't have a lot else this morning. And again, we'll kind of be paying attention to these last few little earnings reports that are coming in. But again, all the majors already done. So there's really not much there other than NVIDIA, which comes at the end of the month. That's going to have a big impact on semis. Obviously, AMD had a really, really good report. They had a very strong growth in revenue. So you would expect if AMD is doing well, that NVIDIA is doing well also. But again, there's no guarantees. If NVIDIA, Tesla, Microsoft, those companies make up big chunks of the CPU orders or GPU orders for NVIDIA. So if for some reason those orders were cut, I would have expected to see some kind of pre-announcement from NVIDIA at this point. If that was the case, kind of prep the market potentially for a disappointment. We haven't seen that. But when you have big orders being placed by big mega cap companies, there is the risk of disappointment. which is one of the reasons that we kind of sold off a little bit of our NVIDIA, took it back down to target weight. And actually, we have sold NVIDIA several times along the way as it was rallying. And when you look at our positioning in NVIDIA right now, we no longer have any capital in that company. So the only thing that we have right now because of the big run up is just really kind of market money. We've already taken all of our principal back out of it. So we still have a 2% position, but it's all gain money at this point. So it's not any of our investor capital that's in that stock anymore. But again, that's why we were reducing it ahead of this earnings report. Again, we'll see kind of where the market's trading prior to the earnings report. Maybe we'll add to it, pre-announcement, because if they do report good, strong earnings, this is a stock in particular that can be up 10 or 20% in a day. We've seen that numerous times. And again, if they come out and say, hey, look, revenue, growth was strong, revenue doubled, like we saw with AMD, if they come out and give a really bullish outlook for, growth over the next quarter, that stock will be up sharply. So if they come out and disappoint, stock will be down sharply. So again, that's the big risk with some of these, kind of high volatility companies is they're hard to trade because they don't give you a lot of opportunity. If, they report a good number, it's not like they're up, 1 or 2% today and then they kind of keep growing. It's just they're up 20% and then they're overbought again. So it's a little bit of a gamble, kind of managing these positions because of that volatility risk that's in those stocks. But again, as we get closer to the earnings report, we'll kind of evaluate where we are and kind of what's happening. One of the big factors that is really going to be the driver for everything over the next year or two. Now, when you're talking about market outlooks, so it's difficult to provide an outlook for some event that's going to cause a big major downturn in the markets, but economics will suggest that maybe the markets will be more challenged to a forward outlook. I got an email this morning from a gentleman saying, I just want to target an 8% return a year. Okay, I get it, right? Last decade, we've been doing 12% a year on average, right? Not every year, but on average, we've been doing about 12% a year. So I get it. 8% seems reasonable, right? 8% is the long-term return of the market. It's going back 100 years. So you're basically wanting all market return over the last 100 years. And there's that seems reasonable, right? I just need that S&P index just to go up 8% a year. But again, as we talked about before, markets don't compound. But looking forward, it's hard to justify 8% rates of return on an annualized basis with an economy that's slowing down. So the one thing that we want to be talking about, really focusing on, is watch this economic data very closely because that will impact earnings. Earnings estimates are still very, very lofty. Wall Street is very excited about earnings growth going into 2025, but the economic data does not support that. So if we start getting revisions to earnings and that earnings growth rate, that's going to lower the rate of return. It doesn't mean stocks will be negative, but a year where we generate 2 or 3 or 4% return is going to be very disappointing compared to what we've been getting. But that could be a much more realistic outcome, say, in 2025. Just something to think about. All right, we'll come back tomorrow. We'll pick up with our mega cap article tomorrow, talk with John Penn as well. Coming up in the next edition of The Real Investment Show. Have a great day. Like and subscribe to the channel, please. We appreciate it. See you tomorrow.